Okay, so here we are in the question environment, and I want the requirements, and I'm doing part B. Part A we'll do elsewhere, but part B, prepare a report for the board of directors. Yeah, okay. And the first one, calculate the NPV of investment A. So we need to go to investment A, and here's investment A. And it gives you just things to do, the NPV really, fairly straightforward. And then the other thing that I wanted to show you is just down here, it does say that the cost of capital is 12%, all right. But I want to focus on the NPV. So off we go then. So we've got this initial investment of 14 million, and it talks about at the end of year 4. So off we go. We're going to open up the spreadsheet. So the spreadsheet then, I'm going to have year 0, year 1, year 2, year 3, year 4. And I'm going to have a cost of 14 million. I'm going to put that in thousands. So minus 14,000. So far, so good. And it says that they get tax allowable depreciation of 25%, reducing balance in years 1 to 3. And at the end of year 4, any written down value is a balancing adjustment. So very, very simple, very, very straightforward. Reducing balancing, so tax allowable depreciation, reducing balance, they're allowed that times by 25%, aren't they? Okay, and then they're allowed to do the shortcut. If you remember when you do reducing balance, if reducing balance is 25%, just times last year's by 75%. And you'll get there. Okay, and you do that. And then in this final one then, it's the balancing figure. So it's the 14,000 minus, and I'm just writing them out here because it's easier, 3,500 minus 2,625 minus 1,969. Then it comes to 5,906, and I'm done. Okay, next thing, it tells me that as with production facilities, there'll be no residual value in the 25-year project. Okay, so no residual values put in. Sales revenue in year 1 is expected to be 12.75, so let's put that in. So sales, 12.75, 12,750. Okay, yeah, what else have you got to me? This is expected to increase by 5% per year. Easy. So equals that times 1.05. Every year the same, so just go to the little cross there and add it all across. Moving on then, what else does it tell me? Production costs are expected to be 5.25 in year 1. All right, let me do that then. So production costs, 5.25 negative in year 1. Gotcha. What else have you got for me? The pre-inflation amounts for years 2 to 4 are given below, as are the inflation rates. So in year 2, it's 6.2 million with inflation of 6%. So 6.26%, just have to remember that, equals minus 6,200 times by 1.06%. What about year 3? Year 3, it's now gone to 7% and it's 7,100. So 7,100 negative times by, it was 1.06 in year 1 and it's 1.07 in year 2. And in year 3, it's 8% and 8 million. Easier to remember. So equals minus 8,000 times by 1.06 in year 1, 1.07, or sorry, in year 2, 1.07 in year 3, and 1.08 this year, and I'm done. So far so good, keep going. It's anticipated that working capital is 10% of sales revenue, needed years 1 to 4, and I just want to know, will it come back to me? It says there's none needed in years 5 to 25, so I've got this weird thing going on from 5 to 25, but at the end of the 25 years, expected it all will not be released. It won't come back to me. Okay, so let's put all that in then. 10% of sales revenue, so working capital It said negative, it comes out in year 0, so minus 0.1 times by the sales for that year. So that's how much I'd need. Year 2, minus 0.1 times by that, less what I've already put in. Minus 0.1, 10% of sales. Whoops. Minus 0.1 of sales, less what I've put in. And just do the same again. Minus 0.1 of the sales, less what I've put in. Keep going then. They pay tax at 20% on profits the year in which the tax liability occurs. So tax, work that out then. So be careful here. So tax, you don't get taxed on costs or working capital. So tax would be, yes, I'd take into account tax liable depreciation. Yes, I'd take into account sales. Yes, I'd take into account production costs. But no, I wouldn't take into account working capital. So it's all of that. And I think we said 20%, didn't we? Okay, once I've done that, I can just add it all across and I'm done. Only issue is that should be a minus, shouldn't it? Times by negative 0.2 because it's a tax charge. So let's just do all that again. And just doing that, I've noticed that the tax liable depreciation, that should be a negative, shouldn't it? So I need to put all of that in and make that a negative. Because it's depreciation, it's allowable. Yeah. So it goes like that. And that should be a positive there. Okay, so far so good then. Back to the question. An estimate has been made of the discounted, so here's this year 5 to 25, and it says discounted down, that's 5,400 at the start of year 5. So, at the start of year 5. So first of all then, I want my cash flows. So my cash flows would definitely be that one down to there for that column, but it wouldn't be for this one. It would be, don't include your tax allowable depreciation because it's not cash, is it? Okay, so for that down to there, and then once you've done that, get it all across. But it did say at the start of year 5, the cash flows for year 5 to 25 is 5.4 million discounted down at the start of year 5. So I need to put that into start of year 5 is the end of year 4, isn't it? So I just need to put that in, another 5,400 there. Okay, and then I can work out the present value of the cash flows. Remember, I showed you at the start it was 12%. So to do that, I want my NPV working. I want the rate, which was 12%, and I want it based on everything apart from year 0. That gives me that. So now I can just work out what my actual NPV is by taking into account year 0. So sum of that to that. And there you go. That's the NPV done.